In this presentation, we will continue on with the comprehensive problem, this time entering the statement of stockholders' equity. For more accounting information and accounting courses, visit our website at accountinginstruction.info. In prior presentations, we had entered the balance sheet and the income statement. We are pulling this information from, of course, the adjusted trial balance. We have found a home for all of the assets, liabilities, all of the income statement accounts, and we're missing these three accounts here, or four accounts, that we need to find a home for. We kind of summed them up, remember, on the balance sheet. We know they're part of that $105,600, but we'd like to give it some more detail in this point in terms of the statement of stockholders' equity. So to do this, we're going to do a little bit of formatting first. We're going to hide some cells so we can see this statement right next to the trial balance. To do that, we're going to put our cursor on G and just click here on G, and then we're going to select the whole column over to column M. So, and then we're going to let go, put our cursor on the selected area, right click, and hide those cells. And that'll give us our statement of equity right next to where we want to be working here. So we're really looking to find a home for these three, but note too that the income statement is part of this number as well. Now the statement of stockholders' equity is a little bit more confusing than like a sole proprietor because we have different components. Like a sole proprietor, all we have is the capital account, and that's it. But the statement of stockholders' equity, the full statement, would have the components of what we invested, common stock and additional paid in capital, versus what's kind of we've accumulated over time, which is going to be in retained earnings. Now, oftentimes, there's only activity in the retained earnings because that's where we're going to close everything out. That's where the income statement's going to close out to. So sometimes that's all we really need is the statement of retained earnings because it's a timing statement. Remember that it has a beginning and an end. We're looking for things that change. If there's no change to the initial investment, as there may not be in any type of time period rather than the first time period, it may be enough just to look at the retained earnings because that's the thing that shows the change, which is what this statement is geared towards showing. So we're going to break these out. Also note that the ending number here, the total, will be the same kind of for any type of industry, meaning if we have a partnership or if we have a sole proprietor or a corporation, total equity is total equity. So all of this is equity. So when we think of things as a whole and it's not breaking them out into its component parts, such as partners or such as investments versus the retained earnings, then it's all the same kind of story. So when we get to the total column, you'll recognize that this is the same format that we'll see if we were to have a sole proprietor or partnership in terms of the total. Okay, so we're going to start off with, when we do this, we're going to have to set up our columns for the component parts. So like common stock, that's going to be a separate column that will tell the story of common stock in this column. Additional paid in column, capital, also has a separate column. We'll tell the story of additional paid in capital in this column. Retained earnings is going to have its own column, not dividends because I kind of broke that out, and then total. Okay, so that's what we will have. We're going to start off with the capital account as of the end of the time period, and that's going to be the January 1st. So you can type that in there. I just pasted it in there to save some time, or so you don't have to watch me type it in there and probably misspell things. So we're going to start this out because this is our first month of operations. We don't have anything. So this is 0 common stock, 0 additional paid in capital, 0 retained earnings. If we sum up all the zeros with the equals sum function, we get 0. Okay, so obviously if it wasn't the first month of operations, we would have these numbers being our beginning balance, which would probably be just these numbers. So usually these numbers on an adjusted trial balance are the beginning balance numbers unless there was a sale of stock here. So like this number, and this number are usually what are the beginning balance numbers, unless something unusual happened, meaning we issued stock, which happens when we first start the company, and possibly later on, but hopefully we're not issuing stock, hopefully we're issuing dividends. And this number will be whatever it was in the prior time period, so the ending of the prior time period will be this number because we have not yet closed the net income to it. unless we took the draws directly out of it, which here we didn't. We made a separate account for draws. So we're tracking draws like we would, not draws, we're tracking dividends like we would draws in a separate account. Dividends and draws being similar from a sole proprietorship to a corporation. So dividends for a corporation, draws for a sole proprietor or partnership. Okay, so now we're going to have the investments. So what happened? We had some investments. Now, what is an investment to a stockholder, a corporation? That means the stockholder put money into the corporation. Well, when does that happen? It happens when we sell stock. So an investment for a corporation means that the owner put money into the corporation just like they would for a partnership, sole proprietor. But we give that equity investment with stock. So the common stock, this number, all is a result of the selling of stock because it's the first month of operation. So we're going to pull this number over here. Now, this is a credit. We want to have no credits over here. We're going to flip the sign by putting a negative of that number and tab. So there's the 30,000. Additional paid in capital, we're going to take this 70,000 and flip the sign. So we're going to say negative of that number and tab. The retained earnings is going to have nothing there. You could put a 0 or nothing, because obviously retained earnings is the accumulation of earnings. It doesn't have investments. We don't put investments into retained earnings. That's only going to be where we close out net income. So then we're going to sum this up, equals the sum. So the investments are this whole column. I'm going to keep the zeros. I'm never going to sum just half of the column because I want to keep the table as uniform as possible. So then we'll have that for the total investments. Notice the total column, it would be that you can tell the story as if it was a sole proprietor, right? We started the business with 0. The owners put in 100,000. They happen to be buying stock because it's a corporation. If it was a sole proprietor, then they would have put 100,000 into the company. The owner would have put 100,000 into the company. Okay, and then we're going to go to net income. So we'll type in net income. I'll just copy and paste it. And that's going to be, now we see it here. We could pull it from the statement, the income statement, of course, which is where we should pull it, but I hid the income statement. But we know it's this 7,100. So we'll tie it out later and make sure and double check that. But it's this 7,100. We already found a home for it. We found a home for these individual accounts. We're just going to put the total then in the statement of equity. We're going to put that into the retained earnings column. We're not going to put it in the investment column. The investments is when we sell stock, for a capital investment. Here is the accumulation of earnings. We need to flip the sign, so I'm going to put a negative of that number. And then I'm going to sum it up over here, equals the sum. And I'm not just going to point to this number. I'm going to sum the whole column again. Would like it to be uniform. It's like I don't want this column just pointing to that number, and then this column just pointing to these two numbers, and this column not even just I type in 0. That doesn't, I'd rather have the same thing. I'd rather be able to delete this whole thing and just highlight this, autofill it all the way down, have it all uniform. Okay, so then the next thing we're going to have is we're going to have dividends here. So dividends are going to be things going out of the company. So I'm going to put less, I'm going to type this one in here, dividends. So now we're gonna record it less with words. We can tell it's a subtraction because this dividends is a debit account, and all of these are credits. Credits we're gonna win. Therefore, we can tell it's a subtraction problem. It's gonna be bringing down total equity, and it makes sense because this total, if we think of the total column, it represents what is owed to the owners. Dividends are kind of like draws, meaning we paid the owners part of the earnings of the company. And therefore, we don't owe the owners as much. The amount owed to the owners or the book value of the company has gone down by the amount paid to them in the form of dividends. Now, dividends differ from draws a little bit, remember, just in formatting. In terms of this statement, they work exactly the same as draws. We're going to reduce retained earnings. We're going to reduce equity by dividends. The reason they're different from draws is because draws, the owner, the sole proprietorship or partner, has more control over their particular draws. And we can have draws that will be different for different partners. Dividends have to be given to an equal proportion to every stock. So the only way that people get more or less dividends is they own more or less stock. You can't have a stockholder that gets no dividend for the year, typically. So we can't say I'm going to give some of the stockholders dividends or not. So that's going to be kind of the difference of dividends. But for the purposes of this statement, pretty much the same thing as draws. So we're just going to say this equals this number. Note that the dividends do not come out of the investments. We're not going to take the dividends out of common stock or additional paid in capital. We're going to be taking it out of retained earnings. So retained earnings are the earnings that we've retained, meaning the earnings we have not yet given out in the form of dividends. Once again, we'll sum this up, equals the sum. And I'm going to highlight the whole thing. I'm not just going to point to those 1,500. And there we have that. Okay, so then we're going to take the totals at the end of the time period. To do that, I'm just going to copy what we have up here. And notice I changed it to balance. We had before capital. We're just going to take it to balance because the names are up here. So it's not really the owners. We're just going to call it balance and then take the names up here. So I'm going to copy that, right click and copy it. And we'll put that down here, right click and paste 1, 2, 3. Then we're just going to change this date from the 1st to the 31st. So the balance for January 31st, we started at the beginning of the month. We are now at the end of the month. Now to figure this out, we could go from left to right and say, oh, okay, this is going to be 30, this is 70, and then add these up. But it's probably easier to start at the total and then apply this autofill to the left so that everything, again, is uniform. Like, in other words, I don't want a formula here that says this equals this, and this equals this, and this equals this, and this, right? That's not going to be as uniform as we would like it. We'd like to make our table as uniform as possible. If we start with the total side, it'll look like any kind of equity section, meaning we have the beginning balance, then investments are going to increase it, it goes up by net income, it goes down by dividends, and this is really where things get messed up. So it's often easiest for us to think about the total. I'll do this wrong first, and then let's figure it out. So we're going to say, what most people will often do is say equals the sum of these numbers. And then we can check it right here. I don't need to go to anything else to check it right now. I can just say, okay, does that number work? And it should be the sum of all of these. Like, it should be all of this to get to that number. It should be 105,600. And I've got 108,600. So I'm going to say that doesn't look right. If we subtract that out, we're going to say, okay, 105,600 minus 108,600 is 3,000. Oftentimes we're wrong because we subtracted when we should have added, or added when we should have subtracted. So we can usually find that by dividing by 2. Say, is there anything that looks like 1,500? That, of course, is the dividends. So this went the wrong way. We're going to add it here. When it says less, it says it's a subtraction problem. We could put a negative number here to tell our reader that, but it won't always be there. Just depends on the formatting of the financial statements. We just have to kind of know. We said it in words here. We said minus less. So we're going to have to fix this. It's not a sum function. So there's a couple ways we could do this formula then in Excel. We could say equals this number plus this number plus this number minus this number. That's kind of how we would do it in a calculator. R25 plus R26 plus R27 minus R28. Or we can kind of do a sum function and then a subtraction, which would look like this. Equals the sum of these three, 1, 2, 3, brackets, close it up, minus this one. And this is probably the more sophisticated looking formula if you're going to try to give this to your boss or something, or work on the simplest kind of formula. This would probably be a more nicer looking formula. So enter, we get that same number. Now what we want to do over here, I don't want to put the same thing here. Like, I don't want to just say, I don't want this one to just be this minus this. I'd rather have it be uniform. So I could just copy this across and say, okay, I'm just going to autofill this across. And by doing that, if we sum this up, we can see that we're going to get to the same formula and get to that same number. And you might say, well, I don't need this cell or this cell, they're both 0. But why not have them, right? It'll all be uniform that way. So we want to try to keep the formulas as easy as possible, by making them all the same when applicable. So if we do that all the way across, then of course we'll sum this all the way across. That'll give us this number, same formula. We can double check this by adding up this way, which is 105,600. So 30,000 plus 70,000 plus 5,600, 105,600, that ties out to the 105,600 here. Now, that means we found a home for these items, and that looks good. What we're going to do now is just double check all the financial statements and see that this number, double check that it's correct. A couple ways we double check. One, we highlight the whole thing, say 105,600, looks good. Now we'll double check it to what's on the balance sheet. So I'm going to unhide. So I'm going to put my cursor on E and go to N, let go, put my cursor on the selected area, right click, and unhide. And then we can just double check over here, and here's our same number. That's what we're looking for. So this 30,000 is the 30,000. 70,000 is the 70. So we may even want to make these yellow. These should probably be yellow, just to see that they tie out. The 5,6 is the 5,6. And if we want to tie this out directly, notice these are coming from here. We could show our readers this if they're looking at Excel and tie this out now to here. This could tie out to here. This could tie out to here. All right, and these are going to sum up same as this number. So that all works out. This is just breaking out the same numbers as we have here. And then we can see that net income, this number, which should also be yellow, we could say that this number comes from here, the same number. So this number should be tying out to the net income. Also, we originally pulled it from here. It should tie out to here. It's revenue minus expenses. So there we have that. So if we check everything out now just to see if everything works, we're going to say, well, first, balance sheet, is it in balance? Yeah, the total assets equal liabilities plus equity. Okay, and then we're going to tie out the income statement, net income, to the statement of equity. The 7,100 ties out to the 7,100 in the retained earnings. And then we tie out the total equity to the balance sheet. And that, I'm going to make this a little bit smaller, is the 105 and the 105.6. And then the 30,000, the 30, the 7. So those things tie out. If those all tie out, then we have a pretty good idea that we are working here. Everything is in balance. That's nice. And we can move forward. Now there's one last formatting thing I want to mention here. On the balance sheet in the common stock area, we may give more detail in terms of the common stock, like how many shares are outstanding, what's the par value, how many are authorized. So you may often see in the common stock a little bit more detail, something like common stock, and then we're going to say it's a $5 par value, and we could say that it's got 10,000 shares outstanding or authorized, and 6,000 outstanding, something like that. I'm going to make this a little bit larger so it fits on. Okay, and that gives us, so when you see this, that's often, this kind of detail is often a little confusing when we look at the balance sheet. So I just want to point that out. This is just terminology to explain a little, give us a little bit more detail. Notice that 30,000, the reason we have a par value is if we divide it by 5, we can see how many shares are outstanding, 6,000. Now they also might give us the amount of detail in terms of the number of shares authorized. We could be authorized, in other words, have permission to give 10,000 shares, to sell 10,000 shares. That's how much we have permission to sell, but we've only sold and have outstanding 6,000. Notice how uniform this 30,000 is. If we know the par value, we know exactly how many shares are outstanding at this point in time. That's the point. The 70,000 just tells us how much we got paid over and above the par value. And that could change with every offering as the market price changes. So if we offer some stocks today and some stocks a week from now, we're probably not going to offer it for the same price because the market price will have changed in that time period. The par value or the common stock will have the same relationship because we'll sell, it'll all be related to this $5 par. And anything over above the $5 we sold it for will go into additional paid-in capital. For more accounting information and accounting courses, visit our website at accountinginstruction.info.